Let's talk about capital investment decisions. Imagine yourself as some sort of a financial analyst, and the company decides to build yet another factory or start some sort of a new project. Where do you start? The boss wants to find out whether that new project, that new factory, is a good idea. Is it a good investment? Where do you start looking at it? Well, clearly, usually, NPV is always a highlight of any sort of a new project. Look at, for example, those gold miners, gold explorers. They always report data on net present value and often on internal rate of return on any sort of a new gold mine projects. And it can be applied to any other new project. You are perhaps familiar with the formula for net present value. The formula is not the focus of our video today. Using Excel, it's pretty simple to calculate net present value for a given project with a given cash flows. But the main question is where all of this information regarding those cash flows actually comes from. And clearly it comes from financial statements. Of course, there are a bunch of financial statements, for example, balance sheet, cash flow statement, income statement, and others. But what sort of financial statements are there for a project that doesn't exist yet? The company is only now considering whether an investment into this project is a good idea or not. In that case, we are actually talking about pro forma financial statements. These are basically financial statements about the future possible performance of this new project. Of course, nobody knows the future, and there is some level of risk associated with this new project. This level of risk is going to be reflected with this required rate of return for the given new project. And looking at all of the bunch of financial statements, perhaps some of the most important information you want to find within those financial statements is the relative cash flow as it goes into the calculation of your net present value as well as the internal rate of return. But before actually looking at some examples of financial statements, some examples of cash flows, it's important to understand which sort of cash flows are relevant and which aren't. There are actually a bunch of different types of cash flows that might be somehow related to the new project, but not all of them are actually relevant to the calculations. You wouldn't put all of them into your formulas for NPV or the internal rate of return. For example, sunk costs are not included into the calculation of NPV and IRR. Sunk costs are the costs that do not change whether the new project is actually implemented or not, whether the company actually goes on with bringing the new project to life or not. It's easy to think of it as a ship that has been sinking, and it's now sunk. It's gone, so just forget about those costs. They cannot be recovered. For example, let's say your company is considering a new project of investing into a new factory in Japan. Before that can be done, perhaps the company wants to research the market and pay a market research agent for the work of running around Japan and studying possible future demand for your product. Whatever the results are of that market research, whether the company decides to go on with the project or not, that market research agent will have to be paid in either case. That is an example of a sunk cost, which does not depend on whether the project is going to be implemented or not. Hence, it doesn't need to go into the calculation of the relevant costs of the project. It's not part of the relevant cash flow. Next, somewhat ephemeral, somewhat abstract idea of opportunity costs. Not all costs are actually real out-of-pocket costs. For example, if you decide to use some of the unutilized property of the company within the new project, even though the company doesn't have to pay to buy that property, there are still associated costs. Instead of being used in that project, the property could have been rented out. Hence, by using that property within the new project, the company loses the opportunity to earn some sort of a rent on that property. And that would actually be a relevant cash flow that would go into the calculation of NPV and IRR as costs of the project. Another sort of cash flow that's very easy to neglect is side effect. For example, if your company does already run a restaurant successfully and opens another restaurant next door to the original one, there would of course be costs of opening that new restaurant. But what might be very easy to forget is that because of that new restaurant, the original restaurant might actually lose some of the clients. And that reduction in the cash flow generated by the original restaurant is a negative side effect of the new project, of the new restaurant. Hence, this negative side effect should actually be included as a relevant cash flow, as an additional cost of the new restaurant. And that new restaurant or that new factory in Japan would of course include a range of different types of costs, long-term costs such as building that factory, and working capital required to operate the factory from day to day. And it's important not to forget to include the net working capital as relevant cash flow in the project as well. At the beginning, that would add to the costs of starting to operate that factory. Next, interestingly enough, financing costs, or the costs of acquiring money for that new project, are not actually relevant cash flows when we are calculating NPV or the internal rate of return. This is often confusing to some of us. One way of thinking about it is that the risks associated with all of that are taken into account within this required rate of return. And lastly, clearly, taxes are an additional cost to any new investment project. Now we are finally ready to have a look at an example. Let's say we have a 5-year project, you're going to sell tools, you expect to sell 50,000 units per year. You're going to sell them at $4 per unit. The material costs are going to be $1.50, labor costs are going to be $1, all that per unit. Some additional fixed overhead costs of $8,000 per year. Some other admin costs, office costs of $5,000 per year. And let's say the equipment will cost you $90,000 at the beginning. And you are going to depreciate the equipment all the way down to zero. So 100% depreciation in all of these 5 years. The operating capital, the net working capital for day-to-day activities is going to be $18,000. That's going to have to be inserted into the company at the beginning of the life of the project. But because the net working capital is not subject to depreciation, you're going to get it back at the end of the project's life. The tax rate is 26% and the required rate of return is 21%. With any sort of examples like these, you generally have to remember to calculate 3 values: operating cash flow, net capital spending. This is the spending on a longer term capital that is subject to depreciation, and changes in the net working capital. That's spending on the short-term capital that is not subject to depreciation. Once you have these 3 cash flows, you can combine them into the cash flow from assets, which is the operating cash flow minus net capital spending minus the changes in the net working capital. Cash flow from assets is that total final value for the cash flows that you insert into the calculation of NPV and the internal rate of return. So let's start with the operating cash flow. For that, we're going to have a look at income statement, because operating cash flow is equal to EBIT, earnings before interest and tax, plus depreciation minus the tax. So let's make up a pro forma expected income statement for this project. In year 1, this is how the income statement would generally look like. For the sales revenue, we have 50,000 units times $4. That's the expected total sales revenue. For the cost of goods sold, we're going to have the quantity again, 50,000 units, multiplied by the costs per unit, including material and labor costs. That's 1.5 plus $1. Altogether, cost of goods sold is 125,000 per year. Fixed overhead costs 8,000 and admin costs 5,000. Depreciation. Let's see, depreciation is applied to the initial cost of 90,000, and this 90,000 is depreciated completely within 5 years. Assuming straight line depreciation, Assuming straight line depreciation, 20% of this 90,000 is depreciated every year, giving you 18,000. Hence, earnings before interest and tax is going to be the sales revenue minus all of these costs, which is 45,000. In this case, we don't have any information on interest expense, so we just put 0 here. But in any other example on your exams, you might have interest expense over here. This is where you enter that number. Earnings before tax is, of course, EBIT minus the interest expense. Taxes in our case are 26% of the earnings before tax, and the EBT minus the tax payment will give you a net income of $32,560 in year 1. And with this example being relatively simple, we assume everything stays the same for the rest of the 4 years. That gives us the operating cash flow for each of those years of EBIT plus depreciation. We add depreciation back into EBIT because depreciation is not a real out-of-pocket cost. EBIT already includes depreciation inside it with a negative sign, so adding depreciation back with a positive sign cancels out depreciation out of our calculations. Again, that's because it's not a real out-of-pocket cost. And we still need to subtract taxes, giving us operating cash flow, which is in this example the same for each of the 5 years. Next, looking at the net capital spending, we know that at the beginning of the project, we need to spend 90,000 to buy the equipment. After that, over the next few years, we don't actually buy or sell any more of the longer-term assets of the equipment. On a side note example, if the problem said that we sell the equipment afterwards for some amount, then we would have a negative net capital spending, because instead of spending on the capital, we would get some cash back into the pocket from sending the equipment for, let's say, the remaining value of $10,000. That would be negative net capital spending, but that's not in example we have here. And lastly, for the net working capital, at the beginning we'll need to inject 18,000 into the working capital, which will stay within the company until the end of the project. But the changes in the net working capital are going to be the initial increase in the net working capital from nothing to 18,000. That is a positive change of 18,000. After that, for the next several years, we don't have any changes to the short-term assets, to the net working capital within the business. But at the end of the project's life, once the business is closed down, as the net working capital is not subject to depreciation, think of it as, let's say, cash circulating within the business for smooth day-to-day operations. You can withdraw that cash from the closed business back into your pocket. That would be a decline in the net working capital of 18,000. So with any of the projects like these, at the very end of the project's life, we always need to remember to withdraw all of the remaining net working capital, which is a negative change. And lastly then, cash flow from assets is going to be equal to operating cash flow minus net capital spending and minus changes to net working capital. Initially, of course, I need to buy the equipment and inject net working capital into the business. That's a starting cost of 108,000 in year 1. That all makes sense. And copying that formula for the rest of the years gives me cash flow from assets for all of the project's life, which I can actually now insert into the calculation of NPV and the internal rate of return. You might remember in Excel to calculate NPV, just hit equals, type NPV, open the brackets, and enter the rate. In our case, that's 21% cost of capital or the required rate of return. After that, enter the values starting from year 1 rather than year 0. And funny enough, in Excel, we have to add the original costs by hand. That gives us a net present value of nearly 47,000. Positive value, hence, this project does seem to be a good idea. We could also calculate internal rate of return here, equals IRR, open the brackets, and enter all of the values of the cash flow from assets, which gives us a 39% return, 39.1%, which is larger than the required rate of return for this project with the given level of risk. Hence, again, IRR also tells us that this project is perhaps a good idea.